Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me for the segment, we have Hayden Hughes, co-founder and CEO of Alpha Impact, to discuss what the crypto lending market looks like today and how it could shape up as the dust settles. It's great to see you again, Hayden. Welcome back to Trade Talks.
Jill, thank you so much for having me. Great to be here.
You got it. And on June 1st of 2022, you predicted crypto's Lehman moment and said that centralized lending platforms could be in trouble. At the time, the lending market in crypto was working normally and no one had yet stopped withdrawals. Your prediction came true, leading many to ask how you managed to spot this one ahead of time. In fact, we discussed this very topic of consensus just days before this moment took place. What indicators or trends brought you to that conclusion?
Sure. Well, it's certainly a great question, one to be thinking about. I do not have a crystal ball as my wife has suggested I might have, but I think one of the first things that we saw was that, look, since the May 6th collapse, and look, I talked about this when we met in Consensus in Austin, Texas, since the collapse of Terra and UST in early May, we saw the underlying ability of these platforms to generate yield go through the floor. And so naturally, if I'm your bank and I can all of a sudden not make as much interest to pay you, I will lower the rates that I'm going to pay you rather than lose money. And we saw only a very small minority of platforms do that, which signaled to me, that was probably the first signal to me that something was not quite right. There was no rational reason why all these firms should not be able to generate the same amount of yield, but they were still paying it out to users. So obviously the first domino to fall was Celsius. We saw that happen just a few days after our meeting in Consensus. And that was, I think, a surprise to many in the industry that a firm that large could pause withdrawals at that time. But really, there's two factors here, and I'll comment more on both. But between the exposure to UST and Terra, or exposure to basically bankrupt counterparties that can't pay their own debts, one of those two was causing some pain. And I just looked at the lending rates as well as what had been happening on the Alpha Impact social feed.
Yep, and you'd made the point. There's a reason why you earn such high yield to lending your crypto out. And over the past few weeks, we've actually seen Celsius pay down some of its loans to DeFi platforms. Could Celsius open their doors again someday and recover fully?
Sure. Well, I think there's two pieces, right? So Celsius is currently trying to navigate through these murky waters and just recover and keep the doors open, as it were, in terms of not having to bankrupt the business. I have somewhat more confidence on that. What they've actually been doing, and this evidence that we're seeing, it comes from on-chain data. So they're paying down what had previously been over-collateralized loans to some of these DeFi lending platforms. So an over-collateralized loan is when you pay $130 of collateral to borrow $100 of a different asset. Now, a lot of folks ask, why would you do that? Why wouldn't you just sell the 130? But in this case, Celsius is in the business of taking deposits. And so what that means is that they have a lot of assets on deposit that their customers need to get back at some stage. So what they've been doing recently on some of these DeFi platforms is paying down some of these loans so that they can get the 130% back. It's actually in their interest to do this, since they've actually deposited more than 100% in the first place. So if they're repaying a loan worth 100%, they're getting 130% worth of collateral back. So in the short term, I think there's some possibility that they eventually open up withdrawals in small batches for users. It's reported that the size of the hole in the balance sheet is fairly large, in the billions. I don't have the exact number. As to whether they can build trust in the market again, I'm really not sure. We'd have to see what happens over the next few years. This is crypto, and stranger things have happened, frankly. I would struggle to imagine anyone would be in a rush to make deposits to them again if they did open their doors as usual. But hey, let's see what happens.
So Hayden, how are the lending markets today?
Sure. So, as we've seen, the lending markets have really suffered from this crisis of confidence, firstly brought by Celsius and other platforms, Babel Finance and CoinFlex and many, many others. The old saying, Jill, that it's not your keys, it's not your coins, is really ringing true. And there's been an exodus from a lot of these centralized lending platforms. People are wanting to take back custody and actually saying, you know what, it's not worth making 8 or 10% or 20%. The other saying that we've seen a lot recently is, if you don't understand the yield, you are the yield, which sounds a little bit cheesy, but it's a very prescient message, because one of the big failures here was everyone was using UST to generate 20%. When times were good, no one was asking how that 20% was actually being generated, which of course we now realize it was just generated by printing more UST. And we all know how that worked out. So I think there's a lot of uncertainty in the lending markets at this stage, and folks are understandably very concerned to put their assets in some of these centralized platforms.
Right, but it's only the crypto asset class that this has happened to. I mean, we've seen it happen to very established legacy asset classes prior to crypto. This contagion effect has happened. So 3 Arrows Capital has filed for bankruptcy protection. What has been the impact of this filing?
Yeah, sure. So, look, you mentioned traditional financial markets. This is very reminiscent of Archegos Capital Management last year and Bill Huang, with virtually the exact same situation as 3AC. 3 Arrows Capital is 3AC is the abbreviated name. So they filed for bankruptcy protection in the United States. It is a Chapter 15 bankruptcy filing, which means that it is a foreign asset manager that has assets in the United States that's looking to have those assets protected from bankruptcy proceedings. So 3 Arrows famously has been liquidated by many different firms, and in refusing to actually pay some of these uncollateralized loans, they've given themselves more time. Now, right, wrong, or indifferent, these 3 Arrows Capital was viewed as one of the leading funds in the space, and I know Kyle and Sue and have for many years, and I really looked up to them as some of the very top asset managers that were in a different class to the rest of us. So look, I think they had the ability to borrow money without having to post any collateral to anyone except BlockFi. So famously, they represented 60% of Voyager's loan book, and obviously Voyager is a large financial counterparty as well. So the impact of the filing has really been really just to force 3 Arrows and all of their lenders to the negotiating table to try to work out a deal, while 3 Arrows, I'm assuming, is furiously trading away in the background, trying to stem some of these losses so they can repay their loans in full.
We've also heard, to your point, that Voyager has filed for Chapter 11 protection, while FTX appears poised to invest in and possibly acquire BlockFi. What might the lending market look like when the dust settles?
Sure. So it's a really interesting question to be asking, and one of the metrics that I think has come out of this, out of the financial crash in the early 2000s, the concept of daily active users, monthly active users, that was a metric that came out. One of the metrics that I'm hearing a lot of today in certainly crypto M&A circles is the size of the whole relative to the size of the balance sheet ratio. So the idea is, if you have a $5 billion balance sheet with a $2 billion hole, that's a whole lot different than a $10 billion balance sheet and a $100 million hole. So in the case of BlockFi, the hole was relatively small. It was $100 or several $100 million. FTX has offered to plug that hole, and it looks like FTX will actually go through and acquire that firm. Voyager, slightly different scenario. Again, everyone's dating everyone in this story, because Voyager has exposure to FTX. FTX is bailing out Voyager, and FTX's kind of sister company, Alameda Research, has a line of credit with Voyager as well. So Voyager, I think, has applied for its own time to negotiate with creditors. This is a Chapter 11. Obviously, corporate bankruptcies in the United States often lead in the company ceasing to exist at some stage. There's a realistic shot, given the storied nature of this firm, that they pulled through. When the lending market settles, or when the dust settles, I think we'll see a vastly reduced number of competitors. If you look at BlockFi, for example, the FTX deal is a no-brainer from FTX's perspective, because look, there's really going to be no one left. I don't see anyone, the number one competitor, number two competitor, number three competitor, they're all going to be gone or fundamentally different. So I think when the dust settles, it'll be a much smaller industry with a smaller number of firms that hopefully people trust more.
And that's the whole thing. The proliferation in the market needs to be consolidated, whether you're talking about the crypto asset space or you're even looking at the public equity space. We've seen this massive valuation reset, and certainly crypto is not immune to that. Another one of your recent predictions has been that regulators are coming. What might that look like?
Sure. Well, I think what we've seen in the United States, certainly since ICOs became very prominent in 2017, was number one, a very keen interest from regulators, both the SEC and the CFTC, very aggressively looking at this space, trying to answer the question of even very basic questions jurisdictionally, such as who is responsible for regulating token issuance? And that's really fallen on the ambit of the CFTC and the SEC. I think what you'll see with these lending protocols, the vector of regulation will be on the stable coins themselves. It's inevitable that if a stable coin becomes large enough, whether it's 100 billion or a trillion or 5 trillion, there has to be regulation from the Fed's perspective. It just doesn't make sense to have something that's potentially so large that it could destabilize the US dollar or another currency. So I think the specific area that will be regulated first will be stablecoins. You have behavior that is effectively deposit taking and currency issuance. So I think that's probably where to start. I also think, though, that one thing that we've seen in the US has been that regulators have been really struggling with the political situation in Washington and the inability of Congress, to pass regulation. So I would expect that you'll see some prosecutions of potentially some of the companies we've been talking about, maybe some that we're not talking about, where the regulator comes out firing and says, you know what, this conduct is actually fraudulent for whatever reason. It's an unlicensed securities offering, whatever it is. I think you'll see a slow incremental movement towards regulating stablecoins. The Europeans have come out and said that ESMA is going to be the National European Securities Regulator is going to be in charge of regulating stablecoins in Europe, although that regulation seems to be at a very early stage. So look, I think it'll happen in the next 12 months. I think it'll be based on stablecoins. Ultimately, I don't think the US will be the leader, but they'll certainly be the ones shaping the tone as we move forward over the next few years.
Let's go back to FTX. The CEO, Sam Bankman-Fried, he's recently stated that he has a couple of billion to shore up the industry during this downturn. What could be FTX's game plan here?
Well, look, I think from FTX's perspective, the priorities are really clear, and I have to say that I know Sam and some of the other members, Constance, of the FTX team, and they've done a fantastic job building a great product. So I think the game plan over the next little while is focusing on the U.S. market. Sam's priorities reportedly are to, number one, bring derivatives to the United States market, two, achieve a lot of growth in the FTX US side of the business. And three, they've actually just launched on FTX US, they've just launched stock trading totally free. So I should say I don't work for FTX. I'm not being paid to say all these nice things, but I think there's a lot of innovation happening. And it's clear that M&A is an angle that FTX is using to really build their brand inside the United States. So far, I think, I don't think that there's likely to be any bailouts from the federal government of some of these crypto companies. So but at the same time, the crypto industry is still very young and very early. So I think we maybe need a lender of last resort to take us through these times. Ultimately, we see consolidation in many different industries. And look, a lot of folks have compared Sam to the very early JP Morgan founders that famously bailed out the stock market in the early 1900s. So look, we see that continuing to happen. And I think FTX is really looking to acquire wallet share and mind share in the US and across the planet.
And finally, Hayden, this crypto downturn has been especially sharp. What's the forecast for the next few months? Do you think a bottom has been put in?
Sure. Well, I'd hesitate to call a bottom at this stage. I think one thing that I would say is if this isn't it, we're definitely getting there. Most of the modeling we've done in Alpha Impact shows the bottom coming sometime between October and December. However, just as a kind of layperson in the space, it feels to me like all the negative news is out there. I mean, the price impact of another lending platform going under or suspending withdrawals would be negligible. We've kind of priced that risk in. The risk that monetary policy changes or deteriorates, or there's more quantitative tightening, that's obviously a very real risk as we move forward. I think that most of the bad things that have happened in the market have taken place already. And so I would not be surprised if we see several months of sideways price action before eventually bouncing off the bottom for a sharp recovery. One thing I will say with crypto is that it trades at a very high beta to equities. And so what we expect is that whenever the bottom comes in, whether it's in October or December or next year or April or tomorrow or last week, crypto will bounce off that bottom much faster than anything else. And so I'm very happy to be in crypto, and I think it's a very exciting time to be in the markets.
All right, Hayden, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.